All right. Good afternoon for anyone who's logged in. Welcome to the KRAB webinar on the intro to multifamily and commercial investing. It's 12 o'clock now. We're going to let a couple minutes go by so people can log in and get set up. We're excited about this webinar. It'll be very, very educational for people who are interested in learning about real estate investing. We're going to go over the basics, the blocking and tackling, the rebounding of what it takes to invest in real estate. Topic's going to be on multifamily, but this applies for all kinds of real estate. So just sit back and relax. We also record this. This will be on YouTube. So if you want to get a copy of the presentation, also everyone who is logged in will get a copy of the presentation. And today being June 1st, 2017, I am coming to you live from Oakland, California. The NBA Finals getting ready to start. Everybody here is excited. I'm sure everybody in Cleveland is excited. The country is excited. The world is excited. It's a great day. So what a great way to start the day off with this webinar. And let me tell you a little bit of information about KRAB. KRAB stands for the California Association of Real Estate Brokers. It is the state board of NAREB. NAREB is the National Association of Real Estate Brokers. We are the oldest minority trade association in the country, and we stand for democracy in housing. And if you're a member of the National Association of Real Estate Brokers, you are called a realtist. And realtists, like I said, we stand for democracy and housing, and we do that through advocacy, activism, and action. And this is part of our action steps, educating our membership on real estate. Today, we're talking about real estate investing. And so the target, most of the people going to be on this webinar today are real estate agents and brokers. Most of our memberships are real estate agents and brokers. This is an open webinar, so some of y'all may not be real estate agents and brokers. That's all good. But whether you're an agent, broker, you're not involved in real estate at all, I want you guys all to kind of look at this webinar through the lens of an investor. Whether you're just starting out, you never invested in real estate, you never thought about investing in real estate, or you own a few properties, or you've been selling real estate your whole life. Look at this presentation through the lens of an investor. And if you're a broker and agent wanting to get into the business of selling properties to investors, this is the basic information you're going to need to be able to communicate to them and work a deal through from start to close. Okay, so it's about 12:03 now. I'm going to go ahead and get into the presentation, and we will get done at 1 o'clock. You can type questions in. I will get to the questions at the end of the presentation in order to have a nice fluid talk, but I will make sure to answer all questions at the end of the presentation, and we will get done exactly at 1 o'clock. Okay, so let's start in the intro to multifamily and commercial investing. My name is Steve Peterson, and I'm the broker owner of Infiniti Investments. Infiniti Investments is a boutique commercial real estate company, which was established in November 2009 in Oakland, California. And right now, I am the 2017 KRAB president. Our company, Infiniti Investments, we specialize in the sales and syndication of mid-size apartment buildings, not really the really big ones and not the small ones either, kind of the mid-size apartment buildings, kind of from 4 units to 100 units. That's what we specialize in. And so as the state president for KRAB, my goal is to bring as much information, knowledge, networking in regards to the multifamily business as possible. So that's why that's why we're doing this webinar here today. Now, let's get into it. Let's get into why buy multifamily properties. Now, like I said at the beginning of this presentation, this webinar, the information here is going to transcend to all properties. whether you're buying single family homes, whether you're buying hotels, or even looking at other businesses or maybe even stocks to invest in. What we're talking about is the fundamentals of how to evaluate the properties. Now, we like multifamily properties, and here's a few reasons as to why. And that's why I built my whole company, around this product type. Number one, multifamily properties generally have a stable cash flow during the holding period. Stable cash flow during the holding period. Whole period, you'll hear this term in real estate investments, is the time that you own the property. It could be 2 years, it could be 50 years. But during the time that you hold that property, the holding period, there's generally a stable cash flow. When you compare that to, let's say, hotel properties, office properties, retail properties, multifamilies have a far more stable cash flow during this holding period and during different economic times, in times of Great Recession and times of economic booms. They have a stable cash flow. So that we like them because of that. And they have that stable cash flow because of high occupancy rates historically and certainly currently. Here in the Bay Area, in Oakland, the Bay Area, occupancy rates are very, very high. Most buildings are full, if not have very low units that are vacant. But even in the crash, in the worst times of the crash, I remember 2009 when I started my firm was kind of like the worst time of the crash. Even then, the occupancy rates were higher than other properties. They're higher than single family homes for sure. They were higher than hotels, office, retail. They were higher than anything else. So we've seen that during the good times and during the bad times, multifamily properties keep occupancy rates high. Another reason we like these type of properties is that financing is available at attractive rates, again, compared to other product types. And right now, units, and let me just say this. Multifamily properties, for the purpose of what we're talking about, are apartment buildings that are 5 units and above. 5 units and above. Because those properties are now commercial real estate. When you go and get a loan for a 5-unit building, that is a commercial loan. A property that's from 2 to 4 units, that's residential income, right? So a duplex, triplex, fourplex, that's still a residential loan. When you get a 5-unit and above, now that's a commercial loan. Right now, and historically, the financing for these type properties, 5 units and above, is the best in the business, the best you can get. Even better right now than 2 to 4 unit investment property. Now, if you're buying a 2 to 4 unit as a homeowner occupant, you're going to get a better rate. But if you're buying a duplex to fourplex as an investor, actually, you're getting better rates on 5+ unit buildings. So that's why another reason why we like multifamily properties. And here's another key. Economies of scale that single family residences don't have. And also in the commercial world, single tenant, triple net properties. And this is an example of that would be like a Walgreens. Walgreens is a single tenant, typically in one building, standalone. So as long as they're in there, they're 100% occupied. But if Walgreens leaves that property, now that property is 100% vacant. Same thing with a single family home. And you have one rental unit. So as long as it's rented out, you're doing good. You got 100% occupancy. Soon as that person moves out, though, you got 100% vacancy. So in a multifamily properties, let's say we have 10 units, 3 of them go vacant at the same time, which is a lot. Now that would be 30% vacant. That's high. But you still have rental income coming in from 7 units. That's huge. That's really huge. So that allows you to balance out, and again, the good times and the bad times. So we like the economies of scale in multifamily properties. It's also an excellent generator and preserver of wealth. This is what I mean by that. If you don't have money and looking to come up as an investor, you're looking to come up quicker, and you're looking to just get more return on your time, so to speak. We're all busy. We don't have a lot of time, especially if you're a real estate agent or broker. You're very busy. So if you're going to go and spend some time investing, why not get the best return for your time and your dollar? So that's what I mean by it's an excellent generator of wealth. You can move up in the wealth ladder, so to speak, quicker in multifamily properties than you can with single family properties. Now, what I also mean by it's a preserver of wealth, let's say you have money or you have equity that you have in other properties, and let's say you sell a property, you do a 1031 exchange, and you're looking for something else to buy, or you have a big pile of cash and you're looking for a safe place to put that money. Well, multifamily properties is an excellent place to put it because the income is going to, outpace what you can get in the bank for sure. It's going to outpace inflation for sure. And it's going to continue to preserve your money, probably better than just about anything else that you can invest in. There are CDs and money markets. Those are more saving tools than investments. And those, are more just sticking your money and you're not going to lose. You're going to get a small amount of return. But in terms of the actual investment world, this is where you want to be if you have money and you're trying to preserve it. Another key point is that prices, when the crash happened, 2007, 2008, prices dropped more than about 50% from their peak. Certainly here in Oakland, and I believe across the country, as I was investing myself in Ohio and other states, we saw the prices drop dramatically. However, rents never dropped more than about 10%. And then immediately start shooting up around 2010, 2011, especially here in the Bay Area for sure. Start shooting up. All the people who got foreclosed on their homes, they had to move somewhere and they moved into apartments. So again, that made for great prices and great rents, which made for great investments. So that's why I like multifamily properties. That's why our company likes multifamily properties, and that's why you should like multifamily properties. Moving on, here's some key indicators that we look at. So when you're looking as an investor and you say, hey, I made this choice, I want to invest in multifamily properties for my retirement or just to generate cash flow, you need to now have some indicators to evaluate what you're looking at and to see if this is a good deal or a bad deal and to make some investment decisions. And if for most of you real estate agents and brokers out there, in our business, we don't get a pension plan. We don't get a 401k. So our retirement really, it should be based on, real estate investments. So we've got to make that push. And when we're making that push, we got to decide what we're doing. So we're saying get into multifamily. Now we need to have some things to look at to make sure we're making wise decisions. First thing, cash flow. Cash flow, cash flow, cash flow. In the old market, when the market crashed, the biggest thing that I saw where people got into trouble is that when they bought apartment buildings that were breaking even, meaning that the income was just paying the bills, right? So it's just breaking even. People did that because they said, oh, it's just going to keep going up in value. No problem, right? Well, it didn't go up in value. It didn't all keep going up in value. When we hit the crash, it crashed in value. And here's the problem with that is that now a lot of people were upside down, meaning that their value was less than their mortgage payment, upside down, or I'm sorry, their mortgage balance. That's what's called upside down. Your value is less than your mortgage balance. And if you're breaking even, you don't have any motivation to stay in that property. And in fact, most people went from breaking even to being negative cash flow. So that's how a lot of people got into trouble. The people that weathered the storm, and believe it or not, it's a lot of people who weathered that storm, they had cash flow in properties. And so even though the values went down, it may have been upside down, if they bought right, they had cash flow, and that helped them to weather the storm. So how do we measure the cash flow? How do we evaluate the cash flow? We look at the NOI details. NOI stands for net operating income. I'll get into that shortly. We also obviously look at the price and the cap rate. Cap rate stands for capitalization rate, and the price as it in its relationship to the cap rate is kind of what we're looking at, and I'll explain that. Also looking at the return on investment, obviously, and the return on equity. That's a key term you usually only hear in the stock market, but return on equity is a key measure for all real estate, that if you own real estate or you plan to own real estate, you need to know how to calculate the return on equity. And a couple other terms we look at is the cash on cash return. That's very similar to the return on investment. That's the cash on cash return. And then the internal rate of return. The internal rate of return is the overall return of the property. That includes cash flow. That includes principal pay down of the mortgage. That includes appreciation or a loss in value, and it also includes either a tax benefit or a tax tax liability. All those things are parts of the return in real estate. That's another reason why real estate is a great investment, because we don't just get a return in one method in terms of cash flow. Property can go up, and every time you make that mortgage payment, guess what? you're paying down the principal, that's an element of return. So the internal rate of return puts all the elements of return over a period of time and gives you a percentage that helps you to make a decision. All right. So these are some key indicators. We want to make decisions based on indicators, not emotions, not emotions at all. You can't get emotional about investment property. You know, that's another big difference between investment property, multifamily property, commercial property than single family properties. You cannot get emotional. You have to get, focused on the indicators. All right. Now, when we are looking at property, so when you make this decision, you want to invest in multifamily properties. You said, okay, well, here's some things I'm looking at in order to figure out if I want to do a deal or not. Then you need to get into the analysis. So the next few slides, I'm going to be talking about the analysis. You got to find properties first, though. That maybe we should do another webinar on just finding properties. And you want to have a good agent and broker you're working with. You want to be able to know your market. You want to be able to find properties off the market. You can track foreclosures. You can find properties that are abandoned. But when you do find a deal, now you need to analyze the deal. All right. So in analyzing the property, we got to first look at the income. Now, the first thing we want to look at in the income is the gross scheduled rents. The gross scheduled rents is the amount, the total rents that you would achieve if all the units were rented out and everybody paid their rent, right? Everybody don't pay their rent all the time. So if everything is rented out based on what amount of units you have and the scheduled rent for each unit, that's your total gross scheduled rent. Oh, and by the way, when we're looking at this information, we are looking at it annually. That's critical because things vary on a month-to-month basis, but you need to look at the annual numbers because that gives you a good outlook. Things are month to month can vary, but when you look at things annually, that gives you a real good idea of rents and vacancy and so forth. So we're looking at the gross scheduled rents annually. Then we're going to start taking away from that number. And the first thing we take away is vacancy. The vacancy obviously is the units that are vacant, the units that are not rented out. There's going to be a certain amount of units not rented out most of the time. Sometimes buildings are going to be full. Right now, you're going to see a lot of buildings that are full. So even in a building that's full, you still want to apply a vacancy rate. A vacancy rate is going to vary from market to market. And right now in Oakland, I just gave you an example, our vacancy rate's around 2.9%. And so even though most buildings are vacant, when people move out, that creates turnover. There's a loss of rent. That's called vacancy. So even if the building is full, you want to apply a vacancy rate to those rents, and then go from there. If the building stays full, outstanding, great. But you want to make sure you're being conservative, so you apply that vacancy to that gross scheduled rents, and then you want to account for something called loss to lease and concessions. Concessions are like first month free. $99 deposits, things of that nature. Honestly, right now, and I know there's people from all over the state, probably all over the country on this call. You're not seeing a lot of rental concessions right now, y'all. You're not seeing a lot of first month free. You're not seeing a lot of $99 deposits. That kind of that's going away. However, that can easily come back. So you want to be prepared for that. And also, sometimes people don't pay their rent. And when you're looking at a property, you want to look at the last 2 years profit and loss statement, right? And then compare that profit and loss statement with the current rents, because if there's a discrepancy, that usually is when people not paying their rent. And so you have to be aware of that going in, because again, sometimes people don't pay their rent and you have to deal with that. So those are two things that you're going to take away from the gross scheduled rents. Now you can add other income, and then vending. You can add other income and then vending. Now, laundry, vending, some buildings have billboards. Some buildings that are large enough, you can have cable. You can have cable contracts with, let's say, Comcast. Everybody signs up on, for everyone who signs up with Comcast in the building owner would get $10, something to that. Other income is basically other income that you generate not from the rents, right? It's just called other income because it's not generated from the rents. And if you got 4 units and above, you should be able to get some kind of other income, whether that's laundry, whether that's, vending, whether that's, parking. That's another big one. In big cities, parking is huge right now. But you're looking for ways to generate income outside of the rents. And then you add that together, and that comes up with the bottom line number, effective gross income. Effective gross income. All right. So your gross schedule rents minus vacancy, loss of lease, concessions, plus other income leads you to your effective gross income. All right. Now, that's the fun part. The not fun part about real estate investing is the expenses. And here's what I mean by expenses: operating expenses, the cost of doing business. Now, this does not, and let me just say it again, does not include mortgage payment. All right. This is just your operating expenses. That's important as we get to the next couple of slides, because that's how we're going to get to value. The operating expenses, and this is an acronym called TIMR, stands for taxes, property taxes, insurance, management. Now, in management, you have on and off site. Management usually is on and off site. If you're 16 units and above in the state of California, different states, every state's a little bit different, but in the state of California, if you got 16 units and above, you're required to have an on-site manager. There must be someone living in one of the units who is responsible for the building in the state of California with 16 units and above. So if you hire a management firm, the management firm is going to pay that person. They usually give them a free apartment, but they're also going to charge you, and that's the off-site fee. And that's a fee based on the effective gross income that they collect. And usually, for most part, it's just the rents, not the other income. Sometimes they charge you on the other income, but it's usually just the rents. And that fee can vary. That could be from 5 to 7%. It could be from 7 to 9%. That fee usually varies based on the neighborhood, based on the type of property. Is it a really old building and difficult to manage, a lot of maintenance issues? Management firm's going to charge more. Also, bigger buildings, let's say 100-unit building, the percentage is going to be lower. It's going to be like 4 or 5%. Smaller buildings like a 5-unit to 10-unit building, it's going to be 8 to 10% usually. So, but just know the key there is that if it's 16 units and above, state of California, wherever your state is, the minimum amount of units that requires an on-site, there's 2 charges for management. Obviously, we have to pay maintenance, and there's 2 kind of maintenances. The 2 kind of maintenance that I look at is the preventative maintenance and then the emergency response maintenance. The more preventative maintenance you can do, or that a property owner has done, the less emergency maintenance you're going to have. Okay, so that's critical, because when you look at buildings, a lot of buildings have what's called deferred maintenance. You're going to hear that term a lot, deferred maintenance. That means, just like what it sounds, what it means. The maintenance has been deferred. The owner, the manager, whoever's handling business hasn't really handled the business for whatever reason. Maybe they don't have the money, maybe they're lazy, maybe they're busy. But that means they haven't been doing the basic things that they should be doing. Therefore, if the building has a lot of deferred maintenance, you can expect emergency maintenance and repairs to happen when you purchase the property. And if that's the case, you just need to, evaluate that in your price and try to negotiate for it. But when you get your property, make sure that you're doing a lot of preventative maintenance on things, that are small before they become large. That's important. Also, utilities, gas, water, electric, trash, etc. These things must be paid. You want to find buildings that are individually metered for gas and electric, especially. In the state of California, you also want to look for, but there's not a lot of buildings unless they're newer, but you do want to try to look for buildings that are individually metered for water. We just got through a big drought, and so water cost is high, very high. So if the landlord is responsible for paying the water, your bill's going to be high. And here's another thing to think about. If the landlord is paying for the water, the tenant's not really, well, the tenant is not tripping on how long they take a shower. They're going to let the water run a little bit extra when they're washing dishes. They're not paying for it. So if they're paying for it, they're obviously going to be a little bit more aware. But if you're paying for it, they're not. And so your bill's going to be higher. The issue with that, not a lot of buildings are individually metered for water unless they were built in the 80s and beyond. So if you're looking at an older building, you're probably not going to get that. But also you want to look for repairs, and this is including make-ready work, units that get vacant, need to be turned, or sometimes there's major repairs, a roof, a water heater, so forth. So you want to look out for that, and you look at the way you evaluate it is you look at the owner's last 2 years profit and loss statement, and you want to try to figure out what's regular maintenance versus what's major repair. Okay, those are two different deals. Somebody needs to come get their toilet fixed. That's regular maintenance. Okay, a roof tore off and we repaired the roof. That's a major repair. So, and sometimes, those numbers can be huge numbers that can distort, the rest of the operation. So you want to just make sure, what that is. And you want to question everything when it comes to expenses when you're looking at properties. Last line item we look at is reserves. Okay, reserves. You want to make sure you have a rainy day fund in case when you own it, that water heater busts or that roof, got some issues. You want to make sure that you're on top of it. So, and some properties are required by the lender to set aside a certain amount of money in reserves. If you have a loan with HUD, with FHA, and yes, FHA does make loans for apartment buildings, so does Fannie Mae, and so does Freddie Mac. Right? And if you get one of those loans, the agency loan, they call them government agency loan, they're going to typically require you to put a certain amount per unit away a year in the reserve account. I believe FHA standard used to be 300. I believe it's 350 a unit per year. So 350 per unit per year. If you have an FHA loan is what they're going to require you to put away. But I always say, just for your own sake, put some money away for a rainy day and budget that into your numbers when you're doing your analysis. Better to be safe than sorry on this. All right. So that wraps up the operating expenses. I just want to say this. There's also could be, depending on your building, other expenses such as pest control, lawn care, pool maintenance, security, right? I'm in Oakland. I work mainly East Oakland. So a lot of buildings got security in East Oakland, but even high-end buildings have security. So those are just, line item expenses. You want to identify what the owner was paying in the last 2 years, and you want to be ready for that. But this here is just the basic expenses that's pretty much going to be on all properties. So be aware of that. All right. Now, and moving on from here, we're going to talk about the main thing in evaluating income property and evaluating multifamily property. That is the net operating income. The net operating income, also known as the NOI. So if you hear people say NOI, it means the net operating income. And let me just say this real quick. A lot of you guys who on this call, you might be in residential real estate, want to break into commercial real estate, want to break into apartment buildings, either as an investor or broker. It's important to learn some of these terms and know the lingo, because a lot of brokers, commercial brokers, they're gonna speak this lingo kind of naturally, and some of them are gonna speak this lingo on purpose to see if you know what you're talking about and to try to test you out. They do it all the time. So you want to know these basic terms so you can be able to talk with them and negotiate with them and to let them know that you know what time it is, you know what you're doing. So when you hear NOI, that just means net operating income. And it's basically that income, that effective gross income minus the expenses, the total operating expenses. Now, here is the key. Operating expenses, not mortgage payment. In commercial, we call a mortgage payment debt service. So net income after accounting, net income accounts after accounting for all income sources minus all non-debt service expenses. So all expenses that do not include the mortgage payment. I want to just reiterate that again. I see this a lot. I see a lot of investors, new and old, putting the mortgage payments into their expense calculations, and that throws off the net operating income. You do not want to throw off the net operating income because that's how you're going to calculate your value. The value of the property is the key determinant to the value of the property is the net operating income. And essentially, it's what's left after you collect the rent and pay your bills, but before you pay your mortgage. That's a simple way of looking at it. I try to look at things as simple as possible. The NOI, the net operating income, is what's left after you collect your rents and any other income, pay your bills, but before you pay your mortgage, all right? And that's a key number because, as you'll see in these next slides, that's how we get to the value of the property. And again, the net operating income is what you use to pay your mortgage, all right? So it's a critical number. You don't want to mess up on that, all right? Now, the reason why the net operating income is a critical number is because that's how we get to the value. How we get to the value is we capitalize that net operating income. In other words, we apply what's called the capitalization rate to that NOI to get to your value. And this is another key term you need to know in the multifamily and commercial business is the capitalization rate, known as the cap rate. And essentially, it's the rate of return generated by a real estate investment property based on the annual net operating income that a property generates. Now, let me say it again. The rate of return generated by a real estate investment property based on the annual net operating income that a property generates. Basically, it represents the percentage return, that's key, you would get from a building if you paid cash and didn't have a mortgage, right? That's why on the previous slide, I kind of hammered in the point that net operating income calculation does not include the mortgage payment at all. Because say you paid cash for a building, guess what? You would not have a mortgage payment. However, you still would have taxes, insurance, maintenance, management, utilities, reserves, right? Repairs. You're still going to have those numbers. That's what's called the cost of doing business. So that cap rate is a reflection of the return of the building. And essentially that cap rate is the net operating income divided by the purchase price and or the value of the property that you're looking at. That's a rate. It's a percentage. That's your rate of return. So let's look at an example real quick. And by the way, I'm moving quickly through this because it's a 1-hour webinar. Just to give y'all some heads up, I got into the commercial real estate business in 2003. It probably took me about 2 to 3 years to really understand this term. I was real young in the game, but it did take me a while to understand, to really wrap my arms around the capitalization rate. So I'm going to go through it quickly. But if this is a topic or a subject that stumbles you, there's several resources available on YouTube and that we can help you out to understand this as well. So if you don't really quite understand it, don't get discouraged. Just stick with me because I'm going to break it down here on the next page. All right. So here's a cap rate example. This is a real vanilla example, y'all, which I think is a great way to explain something. But in reality, you're probably never going to see any numbers this easy, but just bear with me. So we're going to calculate a cap rate. Let's just say, give an example, we're looking at a building. And let's just say we're looking at a building that has a net operating income, NOI, of $100,000 and a purchase price of $1 million. In the old market, when I started doing these presentations, it was about 2011 and 2012, I would used to say, well, it's about a 10-unit building in Oakland, right? Now that's about a 5-unit building in Oakland right now. And in LA, it's probably 3.5 units. But let's just say, for the sake of this example, we're buying a 5-unit building for $1 million. And that 5-unit building has a net operating income of $100,000. Well, in order to get to our cap rate, we take the net operating income and we divide it by the purchase price. That's capitalization. That's how we capitalize it. We take the NOI, divide it by the purchase price. All right. That's why the NOI is a really important number for us to get. We don't want to miss that NOI number because it really determines our value. Right. The reason it determines our value is because we take that NOI divided by the purchase price. That gets us our cap rate of, Now it's real easy, of 10%. Now, cap rate, net operating income, and purchase price, they are inversely related. Inversely related, meaning that if you have two of the numbers, you can always solve for the third number. I'm sorry, that's an algebra term. I'm sorry to bring algebra up into this webinar, but real basic algebra. But if I have the cap rate, if I have the NOI, I can get the purchase price. If I've got the purchase price and the cap rate, I can estimate the NOI. So if I've got two of those numbers, I can always get to the third. Again, that's why the net operating income is so critical to this analysis. You've got to get this number right. And so therefore you got to get your income and expenses right in order to calculate your capitalization rate. So look, look at it like this. If I bought a building for $1 million and I have a $100,000 net operating income, that's a 10% cap rate. What is that though? That's a 10% yield. That's a 10% return. I put up $1 million. I collect the rents, I pay my bills, and what I have left is $100,000. Now, if I paid cash, I don't got no mortgage payment, right? That $100,000 is my yield. That's the return of the building. And whether you get a mortgage or whether you pay cash, it's up to you as the investor. We would all love to pay cash, right? But most of us are going to be using mortgages. But the property itself yields $100,000. Therefore, the property yields a 10% cap rate. And here's a key with cap rate. It's the opposite to the stock market. It's the same principle. In the stock market, you say buy low, sell high, right? Obviously, that's smart. And with a cap rate, you want to buy high and sell low. So the higher the better when you buy, the lower the better when you sell, because you want to buy at a higher return, and then you want to sell when investors are willing to take lesser return. For instance, right now in the Bay Area, you'd be lucky to get a 5% cap rate, even in a tough neighborhood. You're not going to see 10% cap rates right now. And if you do, that's an anomaly. I'm never going to say you won't see it or it's impossible. I just don't believe in those words. But if you see a 10% cap rate right now in the Bay Area, or even in Sacramento and Stockton, Northern California, I'm sure the same thing for Southern California, that's an anomaly. Most properties are going to be around a 5% cap rate and even lower. So if you had bought something at a 10% cap rate, which was great, meaning you making 10%, and then now all of a sudden investors are willing to take less, let's say 5%, now you're going to make a bunch of money. So the key here is the higher the better when you buy in terms of cap rate, the lower the better when you sell. And that has to do more so with market timing. You can't control the market, but you can time the market, right? That's a key point. Now, moving on, and again, I'm moving through this webinar for the sake of time. If you have some issues with understanding cap rate, definitely ask a question and we'll make sure we follow up with you. That's something I want to try to be as helpful as I can with people, but in interest of time, I got to move on. So here's some other terms that are important to know and important to calculate. First of all, is the net cash flow. It's simply the cash remaining after all expenses and the mortgage are paid. In this instance, the mortgage is paid. We are talking about the we are calculating the mortgage in this one because that's our net cash flow. So that would be our net operating income, right? Minus our annual debt service, our annual mortgage payments. And again, this is the key thing. It's not on the presentation, but key thing to understand, commercial real estate, when we say mortgage payments, that's debt service, right? Debt service. So my net operating income minus my annual mortgage payments is my net cash flow. That's the spendable money. That's cash I can put in my pocket. Now, I'm not, we're not factoring in taxes. If you make a bunch of money, guess what you got to do, right? You got to pay some taxes. But I'm just saying that's your net cash flow. That's the money you put in your pocket if you have a mortgage payment, right? Now, cash on cash return, essentially the cash on cash return is our return on investment, ROI. A lot of people have heard ROI, return on investment. That essentially is our cash on cash return here. It's the net cash flow, the number, the term I just explained, divided by the total cash invested. So let's just say we going back to that previous slide, there's a building we can purchase for $1 million. And let's just say we put down that $1 million, 300,000, right? So our down payment's 300,000, and we're probably gonna have some closing costs on top of that. But let's just say, for sake of example, our down payment's 300,000, let's say. Now that property, I put in my pocket every year 30,000 a year. So I put up 300,000 to buy the property, right? But the property at the end of the year, net cash flow is 30,000. So I would take that 30,000 net cash flow and divide it by my total cash invested, 300,000. And that gets me my cash on cash return. That example would be 10%. And I'll kind of break it down another, shortly in another slide. But that's a key measure because that is the return you get on the actual cash you invest. That is important. The last one is internal rate of return. And let me just say this is more of an institutional measure. In other words, bigger properties, bigger investors are looking at the internal rate of return more so than anything else, because it's more of an institutional measure because it's evaluating everything. Usually, individual investors are more so looking at the cap rate and the net cash flow and cash on cash return. The big investors more so are looking at the internal rate of return, which is the total return on the initial investment on an annual basis once the property is sold. And what I mean by total return, again, that's the cash flow, the net cash flow. That's the principal pay down. If you have a mortgage, every time you pay the mortgage payment, you're paying down principal. Unless it's interest only. Most mortgage payments are in apartment buildings you're going to be paying down principal. You're also property is going to go up or down. And the internal rate of return accounts for that. It also accounts for tax benefit or tax liability. Remember, I talked about net cash flow. We weren't really, calculating taxes, but in internal rate of return, we are. And that's probably why most big institutions are looking at internal rate of return, because they need to see the whole picture, and taxes is a big deal for them. But that is, again, a key measure. Most of our individual investors are going to be looking at cash flow, cash on cash return, and cap rate. The big boys and girls of the business is looking at internal rate of return. All right. So moving on, I'm going to drill into a calculation on cash return real quick. I mentioned it briefly in the last slide where I talked about net cash flow and cash on cash return. But let me just give you some numbers so you can see. Again, cash on cash return is the annual net cash flow divided by the initial investment, the initial cash investment, what you're investing to buy the property. And let's just give, for example's sake, some numbers here that you bought a building, that building, and let's just say in this example, it's a 5-unit building that you bought, and that building generates a $15,000 net cash flow, right? Net operating income minus your debt service, it would equal your net cash flow. That's $15,000. And let's say on that same building, you have an initial investment that's equal to $100,000. So that was your down payment plus any closing costs, $100,000, right? So you bought a building, put down 100 G's, and that property nets you $15,000, right? So how do we calculate the cash on cash return? We take the $15,000, the annual net cash flow, we divide it by the initial investment, $100,000. That equals 15%. These measures, when we talk about measures of return, it's always going to be calculated in a percentage. So by taking the smaller number divided by the bigger number, that gets us our percentage. So we take our, net cash flow divided by our initial investment, that gets me 15%. Here's what I have to say about that. Ideally, you want to achieve double-digit cash on cash return. Very, very difficult to do in the Bay Area. I'm not going to say impossible. It's always somebody doing the impossible. So it's not impossible, but very difficult. But here's the bottom line. Cash on cash return needs to be higher than the going in cap rate, okay? Because you don't want to be losing money. So I'll explain kind of what the going in cap rate is in a couple of slides, but your cash on cash return needs to be better than your cap rate. I mean, if you have a mortgage involved, you want that mortgage to increase your return, not decrease it, right? So that's just another, thing to look at. Your cash on cash return needs to be higher than the going in cap rate. So if your cap rate is, 5%, you need to have a cash on cash return of at least 6% or better. All right. Moving on, we got about 15 more minutes. Here's another key indicator. It's called return on equity. Now, again, this is a term probably more widely used in the stock market, but it's very, very important to real estate, especially once you own property. Some of you on this call might own property right now. And this is when you are making decisions on whether you should maybe sell and do a 1031 exchange, or hold on to the property, or maybe refi, pull out some cash and go reinvest. You want to evaluate the return on equity to help you make that decision. So first of all, we need to know the annual net cash flow. Just like return on investment, the same thing, cash on cash return, we need to know the annual net cash flow. And let's say the same property we're talking about that we just bought on the previous slide has a $15,000 annual net cash flow. But now let's say we bought that property a couple years ago, right? So we bought it at the right time. Now the property has gone up in value. So our $100,000 cash investment, right, now has become a $300,000 net equity. That means the property grew in value. So my 100 grand I used to buy the property grew because the property grew in value, right? We've seen that, haven't we seen that in the last few years? If you bought property in 2011, 2012, I don't care where you were, you're doing pretty good right now because those values went up. And so you got a significant amount of equity. So what you should do now is evaluate that equity and what is it earning you? Because it's not about the cash you got now that you put into it. It's about the equity that cash has created. Is that equity performing? I don't know. Let's find out. So when we look at the return on equity measure, we take that annual net cash flow, 15 grand, and we divide it by the property's net equity, which in this example we're saying is 300 grand. That number is 5%. All right. And just another, rule of thumb to look at is the return on equity diminishes. It goes down. It diminishes as the property appreciates in value. And the reason being is because your equity is growing. And usually when your property goes in value, the cash flow doesn't keep pace. And if it does, that's outstanding. But usually the return on equity diminishes as the property appreciates in value. So in this previous example, in this property example, we purchased the property with $100,000 down, and our $100,000 grew to $300,000 in equity. And we were originally getting 15% on our cash on cash return on investment. But now when we look at the equity is only yielding us 5%. So you might want to consider maybe doing a 1031 exchange. But in order to even think about that, right? Especially today, because that means if you sell a property, and if you don't know what a 1031 exchange is, real quick, when you sell a property in a 1031 exchange and you buy another property of like kind, you defer having to pay the capital gains tax. State of California, with federal and state capital gains tax, you're looking at least 28%. Other states are different, but the Fed rate is 15% off top, and it could be more, but that's the starting rate is 15%. So capital gains is no joke. If you're gonna sell a property, you really should do a 1031 exchange. But before you put that property on the market, you need to evaluate your return on equity as it relates to your return on investment. So that's what we're doing in this slide here. So we bought this, let's take it from the top, all right? And I'm moving quick here because we got 12 minutes. But let's take it from the top. We bought this building a couple years ago with 100 grand. We put 100 grand down. That 100 grand earns us 15,000 a year, right? That equals a 15% return on investment. Excellent return. Then we've owned it for a couple years, so the property's gone up in value. But the cash flow has stayed the same. So the same $15,000 cash flow we take and divided by now our equity. We got 300 grand of equity. I mean, if we sold it, we can get 300 grand. But so that 300 grand, that return on equity is only 5%, right? So we look at, well, hey, if I wanted to accelerate my cash flow, if I wanted to, again, this goes into how multifamily properties is a great generator of wealth, because that 100,000 now created 300,000 of equity. You say, hey, maybe I want to cash flow. I want to accelerate my cash flow. So I'll think about selling and doing a 1031 exchange. I could take that 300,000 and put that towards a new property, right? And let's just say in today's market, right, versus 2014, 2012, today, property values are much higher, right? Which means in the investment world, investors are willing to take less of a return, meaning that you go out and buy that property today, you're not going to get that 15% you got when you originally bought the property, right? 9 times out of 10, unless you find the deal of a century, you're not going to get that same 15%. All right. But let's just say you went out, you took the 300, you sold, you did a 1031 exchange. You took the 300,000 and you put it towards a new property. Let's say that new property yields you $30,000 a year, right? So now your net cash flow is $30,000 a year. Well, check it out. On that $300,000 investment, that's only 10%, right? Because you bought in a market that's a tougher market. The values are higher. You're not finding 15% deals no more. You can only find a 10% deal, which, by the way, in the Bay Area, California, anyway, that's very difficult to do. You can achieve those numbers in other states where there is much better cash flow. But let's just say you bought a property that's only yielding you 10%. Okay. And a lot of investors are going to say, why would I do that? I bought a property that was yielding me 15%. I'm doing great. Why would I sell and then buy a property that's only yielding me 10%? Well, let's look at the bottom line. I bought that, I first bought the property using 100,000 and that yielded me 15,000, right? Did this exchange and I bought in a market that was tougher to buy in. Prices were up. So I only got 10%. But here's the key. I got 10% on a higher number. I got 10% on my equity of 300,000, not 10% on my initial investment. That's critical. Because why is that critical? What did I do now? I went from making 15,000 a year to 30,000 a year. I just doubled up. I just doubled my cash flow in one move. That's the monopoly move, I call it. Four greenhouses, one red hotel. It's like the formula to building wealth, especially in real estate business. If you sell property, don't take the cash and go to Vegas. Take the cash and do a tax deferred exchange and buy another property. That's a wise move. That's what we're talking about today. Because you could have doubled your property. You could have doubled your cash flow in a tough market, right? And I've got several clients that's doing that right now in today's market where it's very difficult to buy. So that's a key measure of why you want to evaluate return on investment versus return on equity. So you can make wise decisions about what you're doing with your money. And I hope that makes sense, guys, because this is a key to how we, build wealth, and why I said that apartments are a great generator of wealth. You started out with 100, you ended up with 300. You started out with 15,000 a year. Now you got 30,000 a year. Big deal. All right. So we're going to move on and wrap it up. A couple of things I want to let you guys know more about is identifying upside in apartment complexes. Okay. Said this, the income determines the value in multifamily property and income property of all types, right? So a good strategy is to try to find buildings that have low income where you can realistically now, I live in a market where we have rent control. I know LA, a lot of people in LA probably on this call, y'all have rent control as well. So you can't just come in jacking up people's rent, kicking people out. You can't do that. But let's say you find a building that has vacancy issues. So it's mismanagement, or there's an opportunity to build in additional income. You have a 60-unit building. There's no laundry machines. Okay, bam, I can get some laundry income right there. Or, let's just say you have a building where people fighting over parking. Now you start charging for parking. Now I've generated additional income. And maybe you're in a market where there is no rent control and you can increase rents. And in rent control environments, you can increase rent if you follow the rules. And I always advocate, being a realtist, I always advocate on my buildings and the people I'm working with is if I'm raising rents, to do it within reason, not to do it to where it displaces people. I really don't like displacing people, and I don't like that idea. There's better ways to making a profit, but you can incrementally increase the rents. And look for also ways of realistically now reducing the operating expenses. Okay. And this is maybe putting in some solar to take care of the PG&E. Or, if the building had a lot of deferred maintenance, you come in, you clean it up, and now the maintenance cost annually is going to be less, because what you're looking for here is ways to increase that value. Okay. Good thing about apartment buildings, you don't simply have to wait on the market. You know what I mean? Same thing with any real estate. You get a house that needs some work, you can buy. If it needs some work, you can buy that price X, you fix it up. Now it's worth price Y, or you can sell it for Y. That's the great thing about real estate versus other investments. We can affect the value by what we do on the property, all right? And an income property, it's all about that income, all right? Now, here's real quick what I mean by that. We're forcing the appreciation. It's called the forced appreciation by increasing the net operating income. So what you're doing is you're increasing that net operating income, and hopefully you're increasing that cap rate for you, meaning that you bought the cap rate. What's called the going in cap rate is the actual cap rate day one that you close escrow, right? So let's say that was 10%. Stabilized, maybe you increase the occupancy, you got some laundry income going, and you decrease the expenses. So now your cap rate, your stabilized cap rate, represents the cap rate is reflected, and that is reflected once the property is stabilized, meaning it's renovated, leased up, and expenses are lowered. So now you have a higher cash flow. All right, that's called the stabilized cap rate. And that's really when you buy properties that are underperforming. You can't really stabilize a property that's fully performing, fully rented at the top rents. That's, if you buy a property like that, you're just trying to keep the train going. But if you're looking for ways to, build wealth quickly, if you're looking for ways to, increase cash flow quickly, you want to try to find properties that have some challenges. Word to the wise, though, the property has challenges for a reason. All right. So you want to make sure that reason was the owner and the management, not the market. Sometimes you could buy in certain areas. It ain't nothing you could do to get those rents up. It ain't nothing you could do to rent out those apartments, So just keep that in mind. And moving on, here's my last slide. I got 3 minutes to break this down. I'm going to be talking about in detail at the NAREB National Conference in New Orleans, I believe from the 28th, July 28th to August 2nd. I'm going to be doing a talk simply on creative financing. So I'm just going to talk about these as bullet points, and we'll wrap up the webinar. But in apartment buildings, you have a much better chance to utilize creative financing techniques, OPM, other people's money, to buy real estate. This goes back to the old school Carlton Sheets no money down system. That's actually how I got started in real estate. But you can use some of these techniques to buy and acquire property if you don't have a lot of money, or if you just want to increase the rate of return, or if you have money and you want to buy more property than you have money for. There's a lot of different reasons you can use creative financing. And essentially what I mean by creative financing is methods of financing the acquisition outside of. All right. So the first one we're going to talk about is lease options. In multi-unit properties, a master lease option is the same thing as a lease option on a home, but we call it master lease because we're leasing more than one unit. This is how I got into the business. In 2003, I did a master lease option on a 6-unit deal in Pueblo, Colorado. No money down. I put $1 down, and I actually had to borrow the dollar, but we made it happen. And that's a master lease option deal. Now, when you lease more than one unit, it's a master lease, and the same concept of an option applies. Option is a right to purchase the property. You don't get the full title. You get what's called equitable title, or rights to the title, so long as you follow through on the option agreement. And option agreements are time sensitive. They could be a year, they could be 10 years, but they have to be during a period of time. That means you have a right to purchase the property during that option period. And you also want to include a master lease, which means you're paying the owner a certain amount of money a month, and hopefully you're collecting more money than that so that you're making cash flow. That's the idea of a master lease option. It's a great way to acquire property. A lot of developers also use this strategy when they're acquiring property. Another way of using creative financing is land contracts and / contracts for deed. It's the same thing. This is an installment sale, very similar to a lease option, where you don't get the deed. The deed doesn't come to you when you execute this, but you get rights to the deed, equitable title. Once you fulfill your contract and pay off, then you get the title. Title comes to you, but it's a great way of controlling property before you actually buy it. And in California, we call it a contract for deed. In Ohio, I got experience with this working a deal in Columbus, Ohio. Great city, by the way, Columbus, Ohio. It's hard for me to, being in Oakland right now, to say good things about Ohio in this NBA Finals that's about to go down, but I love the city of Columbus. And in Ohio, installment sales are called land contracts. In California, they're called contract for deed, all right? But it's the same thing. It's an installment sale. You have rights to the title, and you can break up the installments however you can negotiate. An excellent way to acquire property. I'm going to wrap up real quick because we're at 1 o'clock, but wraparound mortgages, that is when the deed does transfer and the property wraps, you create a new loan that wraps around an existing loan. A wraparound mortgage is when the seller has an existing loan on the property, they sell you the property, but the seller creates a new mortgage to you that wraps around the existing financing. It's also called an all-inclusive deed of trust. But the deed does transfer. You get the deed in this method, but the risk is the lender does not know that you guys sold the property like this. So the lender could potentially call the loan, meaning saying, hey, you guys sold the property without our permission. We want all of our money back. That's a risk. Usually they don't do that if they're getting their mortgage payment. If they're not getting their mortgage payment, they will do that. Okay, then there's seller carried first or second deeds of trust. This is the traditional way of carrying financing. This is where the seller becomes the bank. They have to have a lot of equity in their property in order to do this. The deed does transfer, and the seller can carry a note, promissory note. And in the state of California, that's going to be a deed of trust. Back to Ohio, in Ohio, they're called mortgages. At the end of the day, it's all a mortgage, but the language in California is a deed of trust. In Ohio, it is a mortgage. So, but there's a promissory note and there's a deed of trust and a mortgage recorded against the property in favor of the seller. A couple other ways is joint venture partnerships, where you approach the seller and you become partners, equity partners. Another way is crowdfunding. This is crowdfunding, self-directed IRA and 1031 exchange investors, is when you go, the seller wants all their money at close, but you don't have all the money, which means you go to other investors and raise the money. Crowdfunding is an excellent way to do that. A good target for people who would invest with you are people who have self-directed IRAs, individual retirement accounts, and people who are doing 1031 exchanges. And for bigger deals, there's something called preferred equity and mezzanine structured finance. These are big funds that a large part of the down payment required to acquire the property. Creative financing techniques that you can use to acquire property using other people's money, either the seller's money or other investors, okay? It can be complicated and complex, but it's possible. And if you ain't got no money, you got to start somewhere, right? And utilizing creative financing is a great way to do, because you're dealing with the investors. You're not dealing with someone that they own that home. So, with that being said, that wraps up the webinar. I hope this has been, something that you can use to, help you in your investing world. I know for a fact on this call that we have people that are we have some experienced investors. We probably have a lot of folks that are not investors at all. And hopefully the goal of this is that you person, whether you're experienced or you're not experienced, you got something out of this and you can use it in the real world. And I think right now there's a shortage of quality investment information out there. Usually you go to an investment seminar or webinar, it's a little bit of sprinkled information, and then they're selling you a book. We want our value proposition to you at the California Association of Real Estate Brokers, which is the board. We want you to engage us as a group, as an organization, so that you can come and learn more so that you can come and build your network. Most of your deals are going to come from the people you've added to your network. And that's what we bring to the table through these webinars, through real conferences. Like I mentioned, our national conference is going to be in New Orleans, July 28th to August 2nd. It's going to be a great event. And that's what we want you guys to do, is come engage us, come to our webinars, come to our conferences. And me as a company, I put on seminars on a regular basis here in Oakland physically. So if you're in the Bay Area, come check us out. But get on this journey of investing in real estate. So now I want to look and see if we got any questions. And I have, I see Diana Langston says, go Cavs. I see you, Diana. Should be a great battle. Looking forward to it. We've been looking forward to this for a while. I'm scrolling through to see if there's any other questions. I see that a few people had issues with the audio. I am sorry about that. We are working through some of the issues with this new program, Webinar Ninja. I think this is our 4th webinar. So anytime you start something new, there's a learning curve. So we're kind of going through that learning curve, although sometimes, depending on what web browser you have, depending on what device you're using, that could affect the audio. So I'm sorry for those who had issues with audio, but I tell you what, this presentation is being recorded and is going to be uploaded to our YouTube station, Cali Realtors TV. This, you can see this on YouTube. I believe also we're going to email title person, lender. Join the Realtors organization in your local area in whatever state you're in. We stand for democracy and housing. So, be a part of the solution, be a part of equality, and let's go out there and start building some wealth. So with that being said, I'm going to end the webinar. I don't see any particular, Marion Arsenal asks, can we call you? I'll give you guys my business line. It's 510-879-7542, 510-879-7542 is my phone number. Email is Peterson, PETERSON, .infinity, INFINITY @gmail.com. That being said, thank you, everyone. I really appreciate your time and attention today. Hope this was very helpful. And go Dubs! We're ready to hoist up our second trophy in 3 years. Come on, Cavs, bring it on.